I'm bringing this video to you on Thursday instead of Friday so that you can have as much information as possible and as soon as possible given the current market conditions. And the last 2 weeks have been pretty volatile to say the least. While researchers around the world continue to work on treatments and vaccines for coronavirus, the cure for the stock market sell-off is something different. Some believe that the recent Fed rate cut and some more future rate cuts will be the proper medicine. Additionally, G7 finance ministers promised to use all appropriate tools to protect the global economy from the coronavirus fallout. So, where does all of this leave stocks for the months ahead? Let's take a look. For one perspective, here is a chart from thestreet.com. Even though the stock market was plunging, there were some fairly clear lines in the sand. According to traditional technicians, if the S&P 500 could hold the blue intermediate uptrend and the primary uptrend, then the continued bull uptrend remains in play. So far, the S&P 500 has managed to hold on not only above its primary trend line stretching back to before the financial crisis, but also its intermediate term trend lines from the hard decline in late 2018. So, if we are hoping for continued upside in 2020, since the S&P 500 managed to hold above both of these levels, that is a first step. Looking at the charts going back to 2012, the current environment does not appear to be all that unusual. By this chart, it appears we're in the lower third of the S&P 500's trend channel. So as of today, the long-term trend appears intact. Looking at even longer-term data, similar periods of dramatic selling going all the way back to 1933 have historically been buying opportunities. On average, these week-long losing streaks lead to a 16.3% gain a year later, with the stock market in positive territory about 3/4 of the time. However, it may be a bit premature to make that call, as the selling doesn't appear to be over, at least not yet. But let's take a look at the possibilities from another perspective. Jim Reed of Deutsche Bank looked at what happened to the S&P 500 in the week, 6 months, and 1 year after the Fed's last 7 emergency cuts. The chart shows what he found. Essentially, while the near-term impact was most favorable, the long-term was not. As the chart shows, the stock market was up 2.8% after 1 week, but it was down 4.3% after 6 months and down 9.2% after 1 year. I'll have more for you when we look at the charts for the weekly update this weekend. So for today, that's ChewDog Charts. Thank you.